Hello everyone and welcome to the Money Matters. Today, we'll discuss the global financial markets as they make a tranquil transition into April, following a tempestuous start to March. The banking crisis in the US and Europe this month led to a spike in stock and bond market volatility. However, the first quarter has been reasonably good overall. As authorities and central banks analyze the situation and consider measures to avoid future crises, they're focusing on the extent to which underlying economies have been affected. So far, evidence is limited, but the impact on lending and credit will be closely scrutinized moving forward. There's little indication of a broader economic shock, and the economy seemed to be gaining momentum before March. Weekly U.S. unemployment figures will provide further insight into the labor market, while more Federal Reserve officials will share their perspectives. Despite a decline of approximately 20% in U.S. regional bank stock indices due to March's stress, the broader S&P 500 is set to conclude the first quarter with a 5% increase. The tech-focused, interest rate-sensitive NASDAQ is up by 14% during this time. Stock volatility indices have returned to levels seen before the Silicon Valley Bank issues emerged 3 weeks ago. This is partially due to the anticipated credit crunch that may halt Federal Reserve interest rate hikes and lead to easing by year-end. The change in outlook this month resulted in dramatic fluctuations in bond and rate markets. Key volatility indicators reached their highest levels since the 2008 crash, but have since dropped by 25%. Futures markets are uncertain about a potential Fed rate hike in May, but expect policy easing toward the end of 2023. Two-year Treasury yields have stabilized around 30 basis points below their beginning-of-year levels, now slightly above 4%. The economy continues to outperform expectations, with more positive surprises than in nearly a year. In Europe, markets advanced on Thursday, with bank stocks increasing by 2% and credit default swaps on various banks also declining. Even commercial real estate stocks, which suffered during the banking turmoil, began recovering. That's all for today. Stay tuned for more updates on global financial markets, and don't forget to like, share, and subscribe.